We're coming off a down week for the markets. Right now, we're seeing the futures bounce up higher. What do you make of this? What looks like it could be a rebound for the start of this week?
Well, it certainly comes after the sort of surprise rate move on the longer end of the yield curve that in conjunction with selling in some of the big cap tech stocks post earnings was enough to get that pullback, and now we're seeing a little bounce. But unless rates fall notably, I would question any sustainability on the upside and would be more focused on what the potential downside is. I think markets got very comfortable with the downward trajectory of inflation, deservingly so, and believe that the Fed is almost done raising interest rates, which I think they are. But this long end rise in yields caught many by surprise and changes that calculation and shakes up that complacency.
So I really want to focus on today, Peter. So you're saying today you see another difficult day for the markets. I'm looking at the 10-year, just about 4.28 right now. Does that continue to weigh on the market, specifically technology, or do you think other areas are also impacted?
Well, I think there's definitely a flow through with the rise in rates to all other asset classes. Now, stocks could rally today. They can rally through the week for sure, particularly after what NVIDIA is going to say on Wednesday. I just think in order to get a sustained rally from here, you need a fallback in rates, particularly on the longer end. If longer end rates remain sticky here above 4%, I think that an equity move higher is going to be tough because we now priced at a pretty high valuation, 20 times earnings with rising interest rates and very mediocre earnings growth, if that. In fact, we're actually seeing an earnings recession. That's not necessarily the cocktail for a big move higher in stocks, and there's more risk to the downside instead.
All right, so Peter, you're seeing some softness in the market right now. And with that in mind, what is your WEX word of the day?
It's rates.
That's not a surprise. We've said it about 20 times already.
Yeah, I think that's bottom line. And as I said, it's the rate move higher on the longer end, which is market driven. I think is the main factor here because it's not necessarily happening for all good reason. I think the big influences have been the Bank of Japan widening yield curve control, the massive treasury supply at the same time Fed's conducting QT. And in fact, a lot of central banks are doing QT. Then you also have the lack of foreign central bank buying, banks that are not buying, offset by retail and institutions, but that are mostly buying shorter term treasuries. So it's not because we're seeing this sudden acceleration in economic growth. Now, some people are comfortable that maybe we don't go into recession anytime soon. So, but I think some of these
let me jump in. We're really focused on U.S. rates right now. We're talking about it, but there's also a big story today in China not cutting rates on a key lending rate there that really impacts the property market. So how does that make you look at the property market and other Chinese equities today? Do you believe there's even more downside pain to come? Would you perhaps buy the dip today, or would you just stay away from Chinese equities today?
Well, China's residential real estate distress on the developer side is going to be a multi-year process. The positive is that they're hopefully cleansing a lot of these over-indebted developers. Now, cutting interest rates for them, maybe it'll help slightly on the margin in terms of incentivizing demand from consumers to buy and absorb a lot of this excess supply. But we do get to a point where they're pushing on a string, and little tweaks here and there of 10 basis points, 15 basis points and rate cuts is not going to really do anything.
All right, Peter, almost out of time. Very quickly today, is there a sector that you would put money into or an area of the market you would put money into?
We're still bullish on long energy stocks. I think oil prices, while they've had a nice move higher here into the 80s, I think they go much higher over the next 6 to 12 months, and we'll be buying energy stocks.